If you're investing for dividends and passive income, you've likely heard of JEPI and JEPQ. They're both income ETFs actively managed by JP Morgan. JEPI and JEPQ are known for their high monthly distributions, both of which are yielding over 10% at the time of making this video. But which one is better, and more importantly, which one is right for your portfolio? Today we will go over both JEPI and JEPQ's investment strategies, underlying holdings, performance, and risk factors. First off, let's talk about their core similarities. Both JEPI and JEPQ utilize a covered call strategy to produce more income. Selling covered calls on the underlying assets allows the fund to generate more income for investors. The trade-off with covered call ETFs is that you are capping significant upside potential, but you receive additional income in return. Both ETFs also aim to have lower volatility than their underlying assets, and they both have a relatively low expense ratio at 0.35%. Last but not least, JEPI and JEPQ both pay their distributions monthly, which is great for income-focused investors. If you're enjoying the video so far, I would greatly appreciate it if you leave a like and subscribe to the channel. Now, let's talk about some key differences. First off, JEPI is focused on the S&P 500 index. It's primarily composed of large-cap US stocks with a focus on value, favorable risk-return ratio, and low volatility. What that means for investors is that they have broad market exposure, which would be considered more defensive. JEPQ, on the other hand, is focused on the Nasdaq 100 index. It's primarily composed of growth-oriented stocks, which are typically tech-heavy and also tend to have higher volatility. For investors, this means less diversification, but potentially greater returns due to exposure to growth leaders. Historically, JEPQ has had a higher yield than JEPI. This is mostly due to the higher volatility of the Nasdaq 100. More volatility means higher premiums from selling covered calls. However, it's important to remember as investors that higher yield generally comes with higher risk. With that being said, let's take a look at their total return with dividends reinvested since JEPQ's inception in mid-2022. In 2022, JEPI held up very well during a stock market downturn, which shows JEPI's defensive nature. Since then, JEPQ has made a comeback, mostly due to the technology sector's outperformance. Next, let's look at their total real return. Total real return versus simple return means we are accounting for dividends being reinvested and inflation. Over this time period, JEPI had a total real return of about 11%, or around 8% annually. JEPQ, on the other hand, had a total real return of about 29%, or 18% annually. Keep in mind, this is a relatively small time period we are looking at when it comes to investing. Also, remember that historical performance isn't indicative of future returns. So, who is each ETF designed for? Well, JEPI is generally better for conservative investors who want to generate income with lower volatility and more diversification. It's ideal for lower risk tolerance investors. JEPQ, on the other hand, could be better for those who are willing to take on extra volatility and risk for potentially greater returns. Ultimately, the choice between JEPI and JEPQ comes down to your individual investment goals and risk tolerance. If you prioritize stability and broad market income, JEPI might be your pick. If you're willing to embrace more volatility for higher potential income, JEPQ could be a strong contender. Also, there's nothing stopping an investor from holding both JEPI and JEPQ in their portfolio. As always, do your own research when it comes to investing in the stock market. Also, please don't forget to like and subscribe for more videos like this one. Thank you all for watching, and I hope to see you in my next video.